Alright, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty. Today we're going to be taking a look at ticker INTC Intel Corporation. Just give me a couple minutes to double check the stream, make sure everything is up and running correctly, and we'll get right into it. Okay, everything looks good. So before we get started on Intel, we'll kind of take a look at our watch list a little bit, and I'll talk about a few things in the portfolio in general. I've started 2 new positions in the last couple weeks. 1 week and a half or almost 2 weeks ago, I started Valuation, which we valued pretty recently, and then also even more recently we had valued KB Homes, which I started a position in this last week. So both relatively small, and assuming that I'll be dollar cost averaging into them. And both of them I don't really imagine will be particularly large positions per se, but I start small and build into it, so that's where things are with that. Valvoline has definitely ebbed and flowed already. KB Homes is pretty much trading flat, but it's also been a much shorter period of time. But we were pretty impressed with the potential for KB Homes. It's trading extraordinarily cheap with a large amount of cash flow valuation ahead of it by our measure, so we do like that one. But also getting into other kind of like scheduled events and things. We talked about the little stream schedule that I sort of have planned a couple streams back. Today being Intel, the first of which that we'll actually cover of this list. As I said before, there might be a few streams that I kind of pepper in between a few of these, depending on when various 10Ks get released, because it's not so much about when the earnings gets released as much as when the actual 10K gets released, and they're not always released simultaneously. So it depends on those factors. Like I said, today we're doing Intel. That doesn't mean the next stream that we do is actually going to be Facebook, because the timing doesn't really line up for that. But the point is these are pretty high priority valuations in the near future that I plan to do. And then kind of this over here is just another little side schedule of economic data points that come out at various points. Today we got the first advanced estimate of the 4th quarter data for GDP, which I'll say was higher than I kind of had anticipated. I tend to be kind of pessimistic towards economic data a lot of the time, so to be fair, just pointing out my own biases. So it was a larger number than I expected, but I believe it was higher than a lot of the estimates in a general sense. So either way, it looks like it was a pretty good solid GDP number, which could contribute to the market doing pretty good today as well. There was also Apple numbers that had come out that was pretty optimistic on the market in general. But either way, so that's pretty interesting. I will be doing a lot of more data analysis on the other pieces of the GDP that came out with that, because I mean, GDP as is being up and being up higher than expected is good. Even in real terms, adjusted for inflation, it's higher than expected, which is good. But that kind of depends on the component measures that make it up, so that does require further analysis. So anyway, getting into Intel, obviously anybody who's kind of been around the channel will know that we've valued the company a few times before. I think this would be the 3rd time that I've valued it on the channel. It is a holding of ours, which is part of the reason we value it so regularly. But either way, there's some interesting differences in their 10K this year. I did do the prep work that I usually do ahead of a stream, and so that kind of pointed out some interesting things to me. One of which is getting into their debt profile. They massively extended out their expected maturities for their debt. Last year I had them at a weighted average maturity of 13 years, and now they've pushed it to 38. So they've basically tripled their debt maturity profile, which is extraordinary. They did grow it a little bit. It looks to be almost 4 billion more, so a pretty significant jump in debt, like 10% or so. Nothing too crazy, but you know, whatever. To triple your debt portfolio, maturity profile is pretty great. They did also push up the average interest rate, however, so it is a little bit more costly debt, but that comes at the cost of being able to push it up. So on net, it looks like a pretty great set of financing operations that happened in Intel over the course of the year. So that's pretty good for them to see. Other interesting notes, it's not really super important, but in the previous year, the production geographies that I have for them, where they have their PP&E located, in the previous year they had China listed as a specific grouping. And they kind of took the China grouping away, which I found very interesting. It was composed of approximately $850 million worth of equipment last year, and the global grouping, the other category, is a, approximately 1,300 larger this year. So you can see that they didn't necessarily take their assets away from China, but probably just shoved them into this other category here, which I found to be very interesting. It was, however, only like 1.5% of the total PP&E last year, so you could argue that they just wanted to group these into larger chunks, leaving the individual nation ones at chunks larger than 10%. So it's not like there's something necessarily nefarious in there, but I thought it was interesting to have such a strange little change. But as far as that, in the revenues, everything else appears to be about the same. In fact, they increased their Chinese revenue as a percentage by a little over 0.5%, nothing too large of a change really. The other category has jumped by like 6%, Taiwan by like 3%, US has shrunk by 3 to 4%. The other growth did have to come from somewhere, and Singapore has also shrunk as well. So just little changes in the overall geographic distribution of revenues and property for Intel. Now, as far as their sales capital and net margins go, still pretty strong in general. The industry hasn't changed that much. Sales of capital has grown a little bit, while the margins have also grown in the industry, but so has the unlevered beta in general. So the industry that they're a part of has performed much better on a general qualitative basis, but the way that the market has priced those securities has moved up proportionately, it seems like. So we'll get into the actual specific numbers now that I've kind of gone over a little bit more specific detail of the changes over year, since I have analyzed them for a few years now. I will play the fourth quarter earnings call while I do these numbers, as per normal I did do the first year.
Ladies and gentlemen, thank you for standing by, and welcome to the Q4 2021 Intel Corp earnings conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask the question during this session, you will need to press star then one on your telephone. Please be advised that today's conference is being recorded. If you require any further assistance, please press star then zero. I would now like to turn the conference over to your speaker for today, Tony Balow, Vice President, Investor Relations. You may begin.
Thank you, operator. Welcome to Intel's fourth quarter earnings conference call. By now, you should have received a copy of our earnings release and the earnings presentation. If you have not received both documents, they are available on our investor website, INTC.com. The earnings presentation is also available in the webcast window for those joining us online. I'm joined today by our CEO, Pat Gelsinger, and our new CFO, Dave Zinsner. Also joining us is our prior CFO, George Davis. In a moment, we'll have brief remarks from Pat and Dave, followed by Q&A. Before we begin, let me remind everyone that today's discussion contains forward-looking statements based on the environment as we currently see it, and as such, it does include risks and uncertainties. Please refer to our press release for more information on the specific risk factors that could cause actual results to differ materially. A brief reminder that this quarter we have provided both GAAP and non-GAAP financial measures. Today we will be speaking to the non-GAAP financial measures when describing our consolidated results. The earnings presentation and earnings release available on INTC.com include both the full GAAP and non-GAAP reconciliations. In today's call, we will be discussing both the Q4 2021 and the full year 2021 results, providing forward-looking guidance for Q1 22. We will be providing guidance for full year 22 at our Investor Day on February 17th. With that, let me hand it over to Pat.
Thank you, Tony, and good afternoon, everyone. First, let me say welcome to Dave, who is joining us for his first earnings call. Many of you know Dave well and know his track record of successfully driving shareholder value. We're very excited to have him join our team.
Is it just me, or does Pat have like serious movie phone voice?
A period in the company's transformation. everyone here at Intel wishes him all the best in his future endeavors as he begins his planned retirement in May. Q4 was a tremendous finish to a transformational year where we beat expectations on both the top and bottom line. We exceeded our guidance for the quarter by over $1 billion on the top line, finishing with our best quarter and our best full-year revenues ever. We had a record quarter for DCG where we grew 20% year-on-year and where we continue to be the partner of choice for cloud and data center customers. We expect that our Xeon shipments in December alone exceeded the total server CPU shipments by any single competitor for all of 2021. We had a record year for our client business, and in Q4 we outperformed our plan and delivered another $10 billion quarter, highlighting again that the PC is more essential than ever. Continuing our momentum as the market leader in ADAS and AV solutions, Mobileye grew more than 40% year-on-year in 2021, delivering a 14th consecutive year of revenue growth. And finally, IOTG had another billion-dollar quarter to cap a record year as the need for compute at the edge continues to grow. Supporting these record results, our manufacturing network continued its superb execution throughout the year. As an IDM, we were able to rapidly adjust to support customers' mix changes, often within normal lead time, and manufacture more than 2 million wafers. We broke ground on 2 new fabs in Arizona 3 months ahead of schedule as part of the largest overall manufacturing expansion in Intel's history, and all while managing a challenging COVID environment and focusing on the safety of our employees, suppliers, and partners. We also took several in a series of key steps to shape our business. To begin with, we recently completed the first close of the sale of our NAND business on time, a critical step in optimizing our portfolio in line with our new strategy. Second, we began unfolding our plan to find innovative ways to sustainably unlock shareholder value with the announcement of our intent to take Mobileye public in 2022. Third, just last week we announced our new manufacturing site in Ohio, which will support our future growth and advances our plan to create a more geographically balanced, resilient supply chain. While there is a lot left to do, we're building momentum, and we intend to continue our laser focus on execution, innovation, and growing the business. Finally, Q4 was a sacred moment for the entire technology industry as we led the 50th anniversary celebration of the Intel 4004, the chip that changed the world. Microprocessor technology, sparked by the Intel 4004, allows us to stay connected during the pandemic. It has opened up new ways to work and learn. It has removed geographical boundaries and changed almost every aspect of our lives. We are committed to accelerate this impact for the next 50 years as the insatiable need for compute that started with the 4004 continues to drive the value of Moore's Law. At IEDM, we outlined a long-term path toward more than 10x density improvement in packaging and a 30 to 50% area improvement in transistor scaling. As the steward of Moore's Law, we remain committed to keeping the
steward of
for the
Moore's
next
Law
decade and beyond. Looking across the industry, 2021 was dominated by 2 recurring themes: unprecedented demand and ecosystem supply constraints. The strong demand we saw throughout 2021 continued in Q4, and markets remained robust across all our businesses. We expect this trend to continue as the digitization of everything, driven by the 4 superpowers of AI, pervasive connectivity, ubiquitous compute, and cloud-to-edge infrastructure, leads to an era of sustainable growth. 2021 marked the best year in a decade for the PC industry, with third parties reporting a growth rate of approximately 15%, driven by higher PC density, shorter replacement cycles, and increased market penetration. In Q4, we also saw the strong recovery in the channel as increased supply led to record sell-through for Intel, and we started to see inventories return to pre-pandemic levels. The data center market was strong across all geographies in Q4, led by the enterprise, where the market continued to recover from COVID lows. We expect the data center, network, and edge markets to continue to have robust growth as hyperscalers lay out multi-year cloud CapEx investment plans. The ongoing need for data privacy and security drives additional edge and on-prem deployments. 5G network and edge build-outs are scaling, and workloads like AI continue to expand. This unprecedented demand continues to be tempered by supply chain constraints as shortages in substrates, components, and foundry silicon has limited our customers' ability to ship finished systems. Across the industry, this was most acutely felt in the client market, particularly in notebooks, but constraints have widely impacted other markets, including automotive, the Internet of Things, and the data center. As we predicted, these ecosystem constraints are expected to persist through 2022 and into 2023, with incremental improvements over this period. The industry will continue to see challenges in a variety of areas, including specialty and overall foundry shortages, substrates, as well as third-party silicon. While constraints will remain, our IDM 2.0 strategy affords us a superior position to navigate this environment. With control over our manufacturing network and supply chain, we are able to react to rapid changes in demand and help solve challenges for our customers, suppliers, and partners. Equally important as an IDM, we remain more resilient to foundry price increases, as only a minority of our volume is produced by third parties. Turning from the ecosystem to Intel, we made incredible progress over the last year, improving our execution in technology development, manufacturing, and product leadership. With unprecedented transparency, we laid out an ambitious path to deliver 5 process nodes in 4 years and regain process performance parity by 2024 and unquestioned leadership by 2025. We are shipping Intel 7 in volume today. And as I was able to say last quarter and can reaffirm today, we remain on or ahead of schedule for Intel 4, 3, 20A, and 18A against the timelines we laid out in July. Our manufacturing execution continued to improve, and in Q4, as we shipped a record number of servers, and we have more than a 30% year-on-year reduction in 10-nanometer wafer costs. We had record quarterly increase in our substrate capacity with our vendors, and we accelerated our pace of innovation with a record number of PDK releases and new product introductions in our factories. Finally, as part of our strategy to use both internal and external manufacturing, we signed multiple long-term supply agreements ranging from foundry partners to substrates to equipment suppliers that will support the growth of our business for years to come. In particular, we announced a deepening of our ASML partnership and our leadership position with the second generation of EUV High-NA. In client, we had another $10 billion quarter, and 2021 was our 6th straight year of revenue growth. We feel great about our position within the sustainably larger client market, and we had an all-time record shipments with customers like Dell. We have a great product lineup, starting with Tiger Lake, which has now shipped over 100 million units, making it the fastest ramping notebook in our history. We are extending our leadership position further with products like our 12th generation Alder Lake, the fastest client processor ever, which is now shipping to over 140 customers in 30 countries around the world. As our first performance hybrid product, it features the highest performance CPU core Intel has ever built, as well as efficient cores optimized for power. It leads the industry transition on DDR5 and PCIe 5 to enhance gaming and creator experiences. The Alder Lake family will scale across every PC segment, from ultra-thin and light laptops to enthusiast desktops, where we've now set new overclocking records, to mobile gaming, where the Core i9-12900HK, the world's best mobile gaming processor, is up to 40% faster than the prior generation. Following on the success of Alder Lake, we will continue to build momentum later this year when we expect to introduce Raptor Lake, which is already booted in our labs. In addition to leadership products, we are also driving platform innovations, and at CES we unveiled our 3rd Gen Evo platform. This new generation includes features like intelligent collaboration to optimize remote work and learning experiences, as well as Thunderbolt 4 and Wi-Fi 6E. With no legacy Wi-Fi interference, Wi-Fi 6E will enable incredible performance with low latency, the biggest Wi-Fi advancement in 20 years. We are further reinvigorating the PC ecosystem with technologies like Screenovate, which provides a seamless multi-device and screen sharing experience, which will begin rolling out on select Intel Evo platforms starting later this year. Driven by the strong product and platform lineup, we feel confident in our ability to compete and drive growth going forward. Our data center group had its best quarter ever as customers continued rebuilding their confidence and choosing Intel. Enabled by our IDM advantage, Ice Lake server shipped more than 1 million units, equal to the amount we had shipped in the prior 3 quarters combined. All of our OEMs are currently shipping systems, and all of our major cloud customers have announced instances, including our 3rd instance with Amazon Web Services. Going forward, our roadmap only gets better, and we expect to ship initial SKUs of Sapphire Rapids to select customers in Q1. Sapphire Rapids will offer significant performance improvements across a range of workloads, including AI, where we are targeting up to 30x total gain for Xeon. This demonstrates that a general-purpose CPU with built-in AI acceleration can solve even more customer use cases that once necessitated GPU acceleration. Customers remain excited about Sapphire Rapids, and it has been chosen, along with HPE, to power the new Kestrel supercomputer. Built for the U.S. Department of Energy's National Renewable Energy Laboratory, Kestrel will accelerate discovery of renewable power. Once completed in 2023, Kestrel will have more than 5 times greater capability than NREL's existing system, with approximately 44 petaflops of peak performance. Beyond the core data center, we continue to build on our leadership position from the network to the edge with our comprehensive portfolio of hardware and software solutions. We are leading the transformation of the network, where our Xeon and FlexRAN software are used in almost all vRAN commercial deployments.
Okay, so there's
we
4
are
years.
AI inferencing adoption at the edge.
One more year and we'll do
software and partners
a 5-year
like
analysis.
BMW Group and Samsung in the factory and medical environments. And we are extending the IPU ecosystem and accelerating the creation of fully programmable network by collaborating on new FPGA-based IPU solutions with Inspur, Rugy Networks, and Silicon. In our discrete and accelerated graphics business, we are starting the year very quickly. Alchemist, the first product in our Intel Arc discrete graphics lineup, is now shipping to customers with more than 50 new mobile and desktop designs, including with Acer, Asus, Dell, HP, Lenovo, Samsung, and others. Our Arc family of products will scale from mainstream up to the performance graphics segment and will be available in the market later this quarter. In high-performance computing, our Ponte Vecchio GPU is already sampling to customers. With 100 billion transistors, Ponte Vecchio has our highest compute density ever and, along with Sapphire Rapids, will power the 2 exaflop Aurora supercomputer at Argonne National Laboratory. There are over 100 HPC applications running on Ponte Vecchio, which, enabled by one API, provides a unified and open programming model across CPU and GPU. We are working with numerous partners and customers, including Atos, Dell, HPE, Lenovo, Quanta, and Supermicro, to deploy our HPC-tuned CPUs and GPUs in their latest systems. Our IFS business continues to see strong and enthusiastic customer support. We have a strong pipeline of potential customers, and IP development with the ecosystem is progressing well. We are shipping for revenue on our packaging solutions, and we continue to expect customer test chips in our factories on our Intel 16 process this year. Innovations like RibbonFET and PowerVia are proving to be very attractive features to potential customers, and the Intel 18A design kit has now been released to 3 RAMP-C customers. Overall, we are ahead of where I thought we'd be, and I am thrilled with the progress of our IFS team. In mobility, Mobileye continues to be an industry leader in both ADAS and AV, and we recently hit a significant milestone shipping our 100th million IQ SoC. At CES, we gave a glimpse of the future with the IQ Ultra, which will do the work of 10 IQ5 SoCs in a single package and was designed to deliver the optimum power and performance for a fully self-driving vehicle. In Q4, we also introduced our first autonomous on-demand service in Paris in collaboration with the RATP Group. Paris is the latest in a list of locations where Mobileye is piloting autonomous vehicle test fleets, including New York, Munich, Detroit, Tokyo, Israel, and China. Looking ahead, we still expect to launch commercial robotaxi services in Munich and Tel Aviv in 2022. As we announced in December, we are working to take Mobileye public to unlock shareholder value. We are making good progress, and we'll share more as we go through the year. You'll hear a lot more about how we are re-architecting our business for growth as part of our upcoming Investor Day. We will lay out details on how we are leveraging our core strengths to accelerate our plans and how we are uniquely positioned to create value. We'll give you the proof points you should expect to see in 2022 that show that we are on track for a long-term plan, all backed up by the transparency and accountability that our new reportable segments will provide. Let me close by saying again that Q4 was an incredibly strong finish to a great 2021, and I believe that with growing markets, our strong product roadmap, and our increasingly solid execution, 2022 will only be better. In fact, just in the past 24 hours, we were pleased to see the ruling from the General Court in Europe and their decision to overturn the 1.1 billion euro fine.
Okay, so we'll pause there while I take a look at the 5-year trend and kind of comment on a few of the things that they were saying in there. And as well as we'll take a look, I think, at their earnings deck before I move on as well. So generally, starting as I normally do at the bottom with the sales to capital ratio, you can see that Intel has a pretty low sales to capital ratio, especially relative to the industrial expectations we have of 1.44. In general, companies in electronics, especially in semiconductors, and in semiconductors with lots of like software applications, you might see a reasonably high sales to capital ratio with extraordinarily high net margins. This has to do partially with the split in the industry of semiconductors between fabricators and designers. So typically high sales to capital is going to come to a lot of the designer based companies, and so you could argue that this has been a little bit of a split dynamic that can only be temporary, and it kind of eventually has to readjust towards some sort of middle ground. Intel, being one of the companies that still has a large focus on fabrication, does have a relatively low sales to capital ratio. So they have large capital investments in order to generate new sales and to maintain those sales. They do, however, get extraordinarily large net margins as a result of that, which we'll get into. PE, they're trading currently less than 10, pretty damn cheap, around 8 if you adjust for R&D expenses. However, that's not a complete expensing on the R&D capitalization. We'll get into that when we get there. Getting into the balance sheet, we can see that their shareholders' equity has improved rather dramatically, as well as the retained earnings. In fact, retained earnings is growing faster than the shareholders' equity, which is pretty good to see. And the total liabilities is growing pretty dramatically, but so is the assets. The current liability is growing pretty fast, about as fast as the normal liabilities, with the same thing for the current assets and the total assets. So everything's kind of scaling up at an appropriate pace. They do have a pretty significant amount of cash, but also a pretty significant amount of debt in a general sense. They do have lots of payables, but also lots of receivables. Technically, too many receivables could be a problem depending on the negotiating strength they have with their customers. They do have pretty large bulk customers in a few key players. They did mention Dell and Lenovo and HP in their call, I believe, all of those being in their top 5 customers. Apple, I believe, also is in their top 3. So those are factors to keep in mind, is the negotiating the power they have on the receivables versus their payables. Returns on invested capital, pretty strong. You can see it is kind of trailing downward over time. You could say that that's their returns starting to diminish, but you can also say that that's them making large capital investments in order to boost returns in the future. We'll get into that. Returns on invested equity are significantly boosted as a result of the leverage they have. They don't have a crazy amount of leverage. We'll get into that as well. Free cash flow to equity over a 5-year period, the total comes to $55.7 billion, with the total common payout over that period being $67.9 billion. So they have been kind of overpaying their shareholders a little bit during this period. You could argue that they believe their stock was significantly undervalued, and therefore that this was a forward investment against that. You could also argue that their financing allows them to push these things further. But either way, perhaps too many share buybacks during the period. You can see in 2021 there was way less share buybacks than all the other those 4 periods. So perhaps they'll be doing less share buybacks in the future to match up with the increasing amount of their capital investments. A total adjusted net capex, which is capital expenditures plus acquisitions minus depreciation plus R&D minus capitalization against the R&D. So basically getting a total and plus change in working capital. So getting a total amount of all investment numbers all netted out into a 1-year number, which is the suggested net capex. You can see that it was pretty large in the past, and then it kind of diminished over the few years, and then in 2021 it jumped back up dramatically again. So that could be part of the reason that the cash flow is so low. Getting again into the R&D capitalization, I use this method for companies that have large amounts of R&D or other development and related costs, such as exploration for mining companies. What we do is we essentially add back the R&D to their net income and don't consider it as an operating expense, but instead consider it as a capital expense, which means we take those expenses and we put it on the balance sheet, and then over a predetermined life of the amortizable material, we then straight line depreciate chunks of it off each year accordingly, which means you do have to go back at least 7 to 10 years in order to get a solid chain of the numbers to depreciate it off. I'm using a 5-year basis as kind of like a default arbitrary number to work with. It's also the period for which I forecast cash flow, so there's a reason why I'm kind of tying those two together. But the point is, if I have 5 years of amortizable life, then that means I need to go 10 years back in order to get 5 full years of accurate numbers, because it means that these back years have to depreciate, and by the time you get to this period, only then do you actually have accurate numbers. So what that basically means is, even though we have a 5-year trend right here, for the adjusted net income number, which adjusts for this R&D figure, only this net income is roughly equivalent to what it will be once we're done, because these ones still have excess amount of capitalization that needs to be occurred on them, which we won't have until we have the full 10-year trend in here. So that's just something to say, which basically goes to show that against the reported net income that they have of a net margin of 25%, our adjusted net margin we have is about 30 to 31% or so. So that's basically the margin that I think Intel essentially has, which is how we get the 8 PE for an adjusted corrected PE versus the 9 to 8.6 that the reported PE is. So that's our own adjusted EPS that we use, which is an R&D capitalization method. And anyway, so getting further up into some other things, looking at the revenue over the 5-year period, you can see that they have strong spurts in a few years and then also relatively flat, but it has been pretty consistent growth, even if it is relatively low in some of the years. And then regardless of that, they've had a pretty dramatic drop in their share count, which we talked about with the share buybacks. So I guess that's everything we're going to say for the 5-year period. We'll get back into their call and we'll talk about them more once we get to the 10-year period. Oh, actually, wait, before we get to that, I will cover a little bit from their earnings deck, kind of covering some of the segments. As I was saying, that the revenue has consistently grown over a period. They are pretty proud of their consistent growth in revenue, but that does include a little bit of a shaky volatility in between the client computing group and the data center group, which are the main 2 segments that they have. With data center had a pretty lackluster year last year relative to this year, and it's made up a little bit more ground in the last couple of quarters of this year relative to the last couple of quarters of last year, while client computing, due to a lot of the excess cash out in the consumer economy, has had a pretty good 2020, and then has kind of diminished off as some of the excess money has started to disappear in 2021, while the other business segments, the IoT group and the Mobileye group, have done pretty good across both groupings. The outlook that they provide is only for the first quarter, which they're guiding a little bit over 18 billion for revenue and 52% gross margin, and EPS number, which I think that's their own adjusted EPS, which is different than ours. So anyway, we'll get back into the call now.
The semiconductor industry has never been more competitive than it is today, and we look forward to continuing to invest and grow in Europe. At the same time, here in the U.S., we were very excited to see the progress on the CHIPS Act, with the House introducing their version of the bill yesterday. The President and other members of the administration have been clear on the importance of this transformational investment, and it's encouraging to see the strong bipartisan and bicameral support as we continue to work together to address the long-term impacts of the semiconductor shortage, restore U.S. leadership in this critical industry, and rebalance the global supply chain. With that, let me turn it over to Dave.
Thanks, Pat, and good afternoon, everyone. First, let me say how happy I am to be part of Intel. It's a really exciting time, and I'm looking forward to the opportunity to support Intel's transformation and plans for growth. I think we have a great opportunity to drive compelling returns and shareholder value, which all starts with the plans that we will lay out for you at Investor Day in February. Q4 was a record quarter, delivering a stronger than expected finish to another record year. Both DCG and IOTG achieved record quarters, with CCG, IOTG, and Mobileye delivering full-year record revenue. Q4 revenue was $19.5 billion, exceeding our guidance by $1.2 billion. The revenue beat was broad-based, led by stronger than expected enterprise and government demand in data center, desktop PC strength, and better than expected notebook demand. Gross margin for the quarter was 55.4%, exceeding our guidance by 190 basis points due to strong flow-through on higher revenue. Q4 EPS was $1.09, 19 cents above our guide due to strong operational performance. For full year 2021, we achieved record revenue of $74.7 billion, up $1.2 billion from our previous guidance, and up 2% year over year. 2021 gross margin was 57.7%, and EPS was $5.47, up 37 cents year over year. We generated $11.3 billion of free cash flow in 2021, approximately $1 billion lower than prior expectations, as higher net income was offset by Q4 working capital fluctuations. Now turning to our business units. CCG delivered record annual revenue, its sixth straight year of revenue growth, up 1% year over year and up 6% when excluding the modem and connected home divestitures. For the quarter, revenue was $10.1 billion, up 5% sequentially on strong commercial demand. Platform ASPs were up 15% year over year on a richer mix, driven by strong demand for our highest performing platforms and industry-wide constraints, leading our customers to prioritize limited components to higher-end systems. Operating profit was down 3% year over year on increased spending to further strengthen our product and platform roadmap. The Data Center Group delivered a record $7.3 billion in revenue for Q4, up 12% sequentially and up 20% year over year on strong enterprise and government demand. Full-year revenue was down 1% due to a slower than expected recovery earlier in the year, as well as competitive pressure, partially offset by stronger enterprise and government and communications service provider demand. Platform ASPs were up 3% sequentially and 4% year over year on improved mix to our highest performing products. Operating profit in Q4 was down 17% year over year, primarily due to the previously disclosed Intel Federal related one-time charge and 10-nanometer product ramp. Full-year operating profit was down due to lower revenue with an increased mix of 10-nanometer products, Intel 4 startup charges, and increased investment in our product roadmap. IOTG achieved record Q4 and full-year revenue. Q4 revenue was $1.1 billion, up 36% year over year on broad-based strength led by the industrial and retail segments. Full-year revenue was $4 billion, up.
Oh, one other thing I was going to say is that they kept mentioning multiple times their plans to bring Mobileye to the public in 2022. Mobileye's had some significant growth in the last few years, but I don't know if bringing it to market in 2022 is still going to be a good plan. I kind of feel like the last 2 years we've already moved past the hump of the excitement as far as capital markets go for that type of company, as well as I think the excitement for new IPOs is definitely cooled as well. So I feel like they may have missed the hump as far as trying to bring a company like that to public. It might be better off just like continuing to keep it in-house for growth personally, but I don't know, I could be wrong on that. Just kind of a feeling I get about that.
$1 billion for full year, up 43% year over year. Full year operating profit was $460 million, up 91% year over year. Before moving on to Q1 guidance, I want to briefly discuss changes to our non-GAAP reporting beginning in 2022 that we touched on in our Q3 earnings. First, in an effort to more closely align with our semiconductor peers and allow for more consistent comparability between periods, we'll be removing stock-based compensation and all gains and losses related to our ICAP portfolio from our non-GAAP results. Despite this change, we'll continue to closely evaluate stock-based compensation to ensure we're in line with industry benchmarks and optimize ICAP investments to advance our strategy and maximize ROI. Second, we're modifying our segment reporting to align with our revised organizational structure and business strategy. Moving forward, we will report results under the following business units: Client Computing, which includes our historical CCG business plus workstation revenue; Data Center and Artificial Intelligence, which includes our data center CPU products plus our PSG business; Networking and Edge, which includes our IOTG business plus our networking-focused products previously included in DCG; Accelerated Computing and Graphics, which includes all discrete graphics products; Mobileye, which is unchanged from our prior segmentation; and Intel Foundry Services, which includes revenue from our wafer and packaging offerings. This new reporting structure enables transparent accountability relative to how well we are managing and executing against the 6 business units that will be further communicated at Investor Day in February. Moving to our Q1 outlook. We continue to see strong demand across all our businesses, and note that Q1 includes the impact of an additional 14th week. We expect results to be tempered by continued industry-wide component constraints, normal seasonality, and PC notebook inventory burn as OEMs work through inventory imbalances created by ecosystem constraints that have limited their ability to ship systems in certain segments. We expect Q1 revenue of $18.3 billion, down 1% year over year, but up 2% when adjusting for an approximately $600 million one-time corporate revenue item recognized in Q1 21. As we signaled in our Q3 call, gross margin will be impacted by our 10-nanometer product ramp and increased process technology investment. The aforementioned one-time corporate revenue item in Q1 21 will also impact the year-on-year compare. We are forecasting gross margin of 52%, EPS of approximately 80 cents, and a tax rate of approximately 15%. Note that we will provide full year 2022 guidance and more details on our long-term financial model as part of our Investor Day on February 17th. We hope to see you there in person for a full day of presentations and Q&A sessions with our most senior leaders. Finally, I want to thank George for his 3 years at Intel, delivering outstanding results and making many of the changes necessary to begin our transition to a growth company. And now let me hand it off to George to say a few words.
Thanks, Dave. I want to close my final earnings call with sincere thanks to our Intel employees, who amaze me every day, and for the privilege to have served as your CFO. And I could not be more delighted that Dave is taking over, knowing all the incredible strengths he brings to the role. Thanks all.
Thanks, George. With that, let me turn the call back over to Tony to get to your questions.
All right, thank you, Dave. Moving on now to the Q&A. As is our normal practice, we would ask that each participant ask only one question. Operator, please go ahead and introduce our first caller.
Thank you. Ladies and gentlemen, to ask the question, please press star then 1 on your telephone. To withdraw your question, press the pound key. Again, that's star 1 to ask the question. Our first question comes from the line of John Pitzer with Credit Suisse. Your line is open.
Yeah, good afternoon, guys. Congratulations on the results, and thanks for letting me ask the question.
All right, 7 down,
It's great
3 to
to
go.
see a second quarter of year-over-year growth in DCG and an acceleration over the calendar third quarter. But if you look underneath the covers, there's
If you're watching and you're enjoying, please subscribe to the channel, like the video.
Strong. But you look at the cloud part of the business, I think this is the 5th consecutive quarter of year-over-year declines. And so I guess there's two parts to my question. One, when do you see a return to year-over-year growth in cloud? And two, to the extent that the investment community has a bias that everything eventually ends up in the cloud, what is kind of your long-term view of the sustainability of this enterprise demand?
Yeah, hey, thanks, John, and thanks for the comments on a great finish to a great year. So as we look at the DCG business, we just say we started out behind early in the year, digestion, and we've sort of been catching up and building momentum in the cloud piece of that business all year long. And we do see that momentum carrying into next year. So that created some of the year-on-year quarterly compares that you described. E&G, really a tremendous second half and a really strong Q4 for that business where we have higher market share and have seen just a great environment. What we're hearing from our customers is that the momentum in E&G, continues in the next year with very strong backlog positions, and it would have been even stronger had it not been for other supply constraints and match sets that we see. And as you may have heard me talk about before, we don't see everything going to the cloud. We see this balance of on-prem and cloud-based delivery, and cloud continues to grow, faster than on-prem, but workloads continue to grow on-prem. Also, we expect to see an acceleration of edge-based, and I spoke about this at our innovation conference, where the big story as we get out to 2 or 3 years from now is going to be accelerating edge growth. And that's an area that Intel has a very strong position in the edge, very high market share, leadership platforms in 5G, in inference and AI. So overall, we expect to see a very balance across our portfolio. We do see strength to see growth in our cloud business next year, continued sustainability of E&G, but the real story over the next couple of years we see as explosive edge growth.
Thank you.
Thank you. Our next question comes from the line of Ross Seymour with Deutsche Bank. Your line is open.
Hi, guys. Thanks for letting me ask a question. Congrats on the strong end of the year, and thank you to George, and congrats to Dave. So with all that out of the way, Pat, I want to talk about the PC market. I know you've been one of the more optimistic folks on that, and the fourth quarter results showed a little bit of evidence as to why you're optimistic. But you also talked about some interesting inventory dynamics in there, where channel inventory was rising. Can you talk a little bit about your expectations for this year? Again, not front-running the analyst day too much, but the expectations for growth for the year, and a little bit more on how you reconcile inventory rising with shortages still persisting.
Yeah, thank you. And 2021 was really good, if not great, year for the PC. I think most forecasts now are coming in estimating about 15% growth last year. As we're seeing IDC, Canalys, modest growth in the market next year. So as you've heard me, and I think this matches exactly what Satya said yesterday, we'll just say a structurally larger market for us for next year, and a couple of percent growth in that. So we see that we will be able to have continued growth in our client business, and obviously with a stronger and stronger product line, we see ourselves in a very good position for our client market share. Now, the inventory position is one where, we have just been at historically low inventories for an extended period of time, just racing to catch up with demand. And so we would say that some of this is just getting to inventory levels that are even approaching what we consider normal for a business of this size, and one that's managing these still
last 2 years
constraints at different areas, power controllers,
we're getting there.
Display lid controllers, other aspects of substrates and different component pieces. So a lot of these challenges, have really led to, I'll just say supply issues, throughout the customer base. So as we go to next year, we hope to see some of those starting to moderate and turn to a more normal behavior in the industry. In particular, the channel inventory levels, the ones that were, essentially zero, right, for almost all of the year. And now we're starting to see just a little bit of build back in that area, which, particularly for our channel and distribution partners, is sort of for the first time giving them something to sell, for the whole year. So a lot of response positively there. And overall, we still see that the PC is now becoming this essential part, in an increasingly work from home, learn from home environment. Windows 11, a strong upgrade cycle being introduced by that. So a lot of good tailwinds and a great product line. It's going to be a great year for us in the client space.
Thanks, Pat.
Thank
Wait a
you.
minute.
Our next question comes
This
from the line
number's
of
wrong.
Joseph Moore with Morgan Stanley.
What did I screw up?
Great, thank you. I wonder if you could talk about the capital spending a little bit. And again, I don't want to tread on material you're going to cover at the Analyst Day, but the footprint in Ohio, the various comments that you've made about not being able to foresee having too much capacity in the next couple of years. As you think about that, how much of that is your existing x86 business versus foundry and other opportunities, and any sense for the capital spending you talked to this year, how much of that is going to be buildings versus equipment?
Yeah, thanks, Joe. And, I'll kick it off and ask Dave to comment as well. Overall, we would just say that, supply constraints, we just have a lot of catching up to do in building out the capital footprint. And some of that is catching up. Some of that's building for, the new process technologies, our 5 nodes in 4 years. But it also is leveraging the smart cap strategy that we've laid out where, I lust for having a free shell today that we could be ramping into. We simply have to build some more shell capacity. And then we'll be determining, where is the best use and how to fill that as we start to build out those shells. Everything that we've described, our Arizona build-out, our Ohio build-out, we do expect that will be satisfying both our internal products as well as creating capacity corridors for our foundry business as well. At Analyst Day, we'll be shaping that with more clarity, and Dave will be giving updates on a number of the capital aspects at the foundry.
Something above this.
For foundry as well as for internal capacity there. So, Dave, what else might you add?
Yeah, first of all, thanks, Pat. And I just did want to say thanks for joining the call, and I'm really happy to be part of Intel. We have an exciting opportunity in front of us.
Didn't I add the restructuring, or did I?
Excited to be a part of IDM.
It's supposed to be minus? That doesn't make sense,
a lot of
but
opportunity to create a lot of shareholder value. In fact, one of the areas we're doing that right now is increasing the dividend 5%. So it's great to my first quarter have a dividend raise. I can't beat that. Yeah. On the CapEx front, Joe.
What is going on here?
As Pat mentioned, we'll give you a lot more granularity in terms of 22 and beyond in terms of CapEx. But if you look back at the 2021 CapEx split, it was roughly 60% equipment, 40% space build out. So that's at least the ratio last year. Of course, it might evolve over time, but it gives you kind of the rough magnitude of the numbers.
Okay, thank you.
Thank you. Our next question comes from the line of Stacy Rasgon with Bernstein Research. Your line is open.
Hi, guys. Thanks for taking my question. I wanted to dig into your inventory comments again. So I know you're saying you're building inventories, but your PC volumes were down 18%.
Like one of these numbers off or something? This doesn't make any sense.
Wasn't down 18% year over year, so it doesn't feel like you're building inventory. If anything, it feels like inventory is bleeding out.
Wait,
so,
how come this line's down here?
So how do I square that?
I just noticed this. That might be my problem. I was looking for this line.
Address that, Dave, or
I don't know how it ended up.
Yeah, maybe I'll just
below.
Comment a little bit on it. When we do a year-over-year comparison, obviously
that must be the problem.
Q4 of last year was a huge quarter for CCG, particularly with the consumer and entry SKUs. And so what we've seen really starting with the second half in particular for 2021 is a rotation out of the consumer and entry area into the
9620, I think that's right. There we go.
And our desktop, which desktop had really dropped off, and now we're seeing.
Must have copy pasted it incorrectly last night.
So if we think a little bit about the growth of CCG year over year, we certainly look to be growing lower than the TAM. But if you take into account the fact that you look at our exit of modem and our exit of home gateway and the impact that had on a year-over-year comparison, that's about six points of growth. And then the customer's decision to go vertical on a large customer that decided to go vertical, that's about another 6 points. So the overall growth, the pattern is a little different because of the mix year over year, but the growth relative to the TAM, when you take into account these changes, is much more in line with the overall growth of the industry.
Okay, thank you.
Thank you. Our next question comes from the line of Harriet Sir with J.P. Morgan. Your line is open.
Hi, good afternoon. Thanks for taking my question. So on Intel Foundry Services, it appears that the team is off to a good start. Looks like a lot of good early engagements. If I'm a potential IFS customer and I start my design today, realistically, right, I'm not expecting my chip design to be ready for manufacturing conservatively for at least 2 years, because that's just how long the design cycle times are for these leading edge chips. And it seems consistent with your prior commentary on IFS customers more focused on your 20 and 18A nodes, which is kind of 2024, 2025 timeframe. So if I think about the real big CapEx outlays to support IFS, my assumption is that it's probably not until 2024 or maybe even 2025 timeframe. Is that kind of the right way to think about it, that most of the CapEx spend for IFS is probably 2 to 3 years away, and more of the CapEx spend over the next 2 to 3 years is to support growth of the core compute businesses?
Yeah, your comments sort of dimensionalize it almost right. The key thing to augment what you said is that to be able to put the capital in place in 24, 25.
All right, one more year.
Be building the shells in 22, 23. So that's what we've, why, for instance, the Ohio announcement, we said, hey, we are building shells so that we can fill it with our products and with foundry customers as well. But clearly, when we get to Intel 3 as well as Intel 18A ramps for foundry customers, those capital investments, most of that being back-end loaded, right, when you're putting equipment in place, really ramp up in 24 and 25. But we've got to start building the shell capacity for those in 22 and 23. Your other comments, we do expect some of the Intel 16 customers, that some of those products will start ramping next year. So we do expect some of those design starts that are already underway today to start giving us some revenues for our foundry offerings on Intel 16 and 23. We would expect Intel 3 to start contributing in 24 and Intel 18A in 25 and beyond. So it's sort of that nice ramp. But we've also said, hey, we already
there's
have
the final income statement.
And those revenues have already started in Q4 of this year.
Now let's do cash flow.
Services, some of these are pay-for services as well, so those will start contributing even before then. But overall, the world wants more capacity. The world is looking for leading-edge foundry capabilities. We've seen very strong interest from many different sectors. And I'll just say, across, whether it's, leading-edge high-performance computing, mobile customers, industrial customers, and clearly automotive customers, a very broad swath of customers who are interested in the Intel Foundry services, and great momentum that we're seeing.
Thank you.
Thank you. Our next question comes from the line of Vivek Arya with Bank of America.
Thanks for taking my question, and thank you to George, and welcome today. I actually had a near and longer term question on gross margins. So in the near term, I'm wondering the 52%, how does this kind of evolve through the year?
There's the cash flow statement.
I'm trying to give a specific number right now.
Now let's get the last balance sheet.
And kind of the key drivers. Is this the floor or ceiling or kind of the average levels that we should be thinking about? And then longer term, Pat, how do we reconcile that your main competitor, who is kind of just fabless, is pretty much at these same gross margins without having to spend any of the CapEx that Intel plans to spend? When can Intel start using the pricing power in the markets where you have very large incumbency? Thank you.
Okay, let me start, and Pat can certainly provide his color around pricing. So you're right that we are going to provide a lot more details around the year at the Investor Day and give you actually some perspective over the longer term. But I think I can help you think through a little bit about the trend. based on the following commentary. So in our third quarter earnings call that Pat and George who were representing Intel, we said that we had to make investments both in terms of newer process technologies and the startup costs associated with that, and we needed to ramp 10 nanometer, and that was going to put pressure on gross margins. And they presented a range of somewhere between 51 and 53% was the gross margin level that we would need to operate at while we were, getting ourselves caught up from a technology perspective. So we're in that range for their guidance of 52%, and we feel very good about 51 to 53% range for the year. So that's so when you look at this number, it can bounce around a little bit, but the 51 to 53% range we've given, we feel real confidence around for the time being. Now, after.
All right, so we'll go ahead and cut it there, so that we can get into the 10-year trend and take a look at everything else. So looking at the sales to capital ratio, as I was saying, they tend to have a relatively low sales to capital ratio. You can look further back into their history. You can still see that that's pretty consistent. It was maybe a little bit higher in this year 6 through 10 period back there relative to the more recent period, but you could argue that that's, again, them making large capital investments in order to generate future sales in the next 5 years. So multiple ways to look at that. As with the PE, they've kind of traded up and down, but they've definitely not been trading super expensive over the 10-year period, other than apparently this period in 2017, which they might have had lower earnings in that year. I can't remember, but either way, still trading relatively cheap in general over the entire time frame. Shareholders' equity has basically doubled over the entire year time frame, while retained earnings has more than doubled, so that's pretty good to see. Total liabilities has more than doubled as well, but so has the total assets, although the liabilities have come up a little bit more than the assets. Though I don't think this company is super levered in a general sense, so that's perhaps a good thing for them to maybe push the leverage ratio up a little bit. As I said, with their current assets versus the current liabilities, they do have a pretty consistent growth in payables, but a much larger growth in receivables. I actually find that to be a little bit concerning to have too many receivables relative to payables. It's definitely not the best type of current assets to have. So it's just a question of whether or not they have the bargaining power against their customers, which maybe they will in the future, depending on their ability to be the only ones to provide the physical manufacturing for the chips. So that's one competitive position they have. It's one of the reasons I like Intel, is that they actually do have the fabs that other companies are acting like are unnecessary for the last several years, but in the most recent 1 or 2 years, we've started to notice how important they actually are. Return on invested capital, as you can see over the 10-year period, has declined pretty steadily downward. So it is perhaps not just a matter of investment, but also of their returns diminishing perhaps over time. Their returns invested equity, though, have maintained relative strength against this. As I was saying, they could be pushing their leverage ratio up, and if they push their leverage ratio up at the appropriate rate, while the returns invested capital move down slowly, then that can actually generally push the returns on the equity up over the same period of time. So that's just good. There's possibilities of maintaining strong returns even if the returns are diminishing in a competition sense. Free cash flow to equity over the 10-year period, if we look to see, they earned $103.9 billion, and if you look at the total common payout over that entire period, it's $107.2 billion. So they're still overpaying over the 10-year horizon, not just the 5-year horizon, but not as bad. It looks like it's a little bit closer to even over that time frame, so it's maybe not as big of a deal. You could argue that's just them paying back what the shareholders deserve to get paid back, maybe a little bit more. But that's not too big a deal. Now, looking, as I was talking about, the net income and the corrected net income and how that relates to the R&D capitalization, so we have the full capitalization effect over these last 5 years, so we can really see a proper trend over these particular years for the net income. These ones are a little bit higher than they ought to be because they don't have the full capitalization effect, but either way, you can still see that over the 3-year period that they've had a strong 28.5 or so net margin. Over the 5-year period, that actually is a little bit higher, I think, or actually no, it pushes a little bit lower, probably because of this really low 18%, which is in 2017, the year that I said I thought they did have lower margin. So that does line up with that. If we do look at the 9-year trend over this period, keeping in mind that it is going to be a little bit high because of the R&D capitalization, If we maybe notch a few points, like 2 or 3 points off of that to get an idea of that, you can see that maybe 3, you'll see that's 26 to 27% over that time frame. So the last 3 years, their margins have been perhaps a little bit stronger than perhaps what an R&D adjustment would have been over the 10-year period, though that's again sort of a ballpark kind of estimate. Looking at their revenues over the period, you can see that they have had the same consistent growth that they have been talking about. There is 1 or 2 years of decline, but on the net over the entire 10-year rolling period, the 5-year CAGR stays consistently strong, pushes upward and then pushes downward a little bit. So nothing too strong, nothing too major, just a pretty consistent mid-single digits across the period. So that gives us a pretty good basis, I think, for expectations as far as the revenue goes. So we'll get into projections. Pay no attention to that. We have a lot of things to adjust before that's going to start to make sense. We'll actually start for this one by adjusting at least partially the margin, because that is one of the major factors that's pushing this down, considering the 3-year period we're looking at 28% margin. Like I said, perhaps pushing upward, pushing downward. I generally try to guide a little bit on the conservative end of things, so we'll probably try to have our midpoint maybe tilted towards around 25 or so. As far as worst case scenarios, I'm willing to go pretty bad as far as worst case scenarios go for Intel, because they're with the competitiveness of their industry and the fact that it is relatively commoditized after a fashion, that does put them in a position to have to defend their competition against pretty much all sides. So on top end of things, if we put 40%, that gets us a balance of 27.5. That's not so bad. I don't necessarily want to put a cap of 45 up. That's a little bit high, I think, as far as the actual potential for our true cap. I think 40 is maybe the true top end that I'm willing to push things for. I would perhaps be willing to just leave it like this and then maybe tilt the probabilities one way or the other. We do have to adjust the analyst number, maybe put 25 for that. We can also put maybe 30. That puts 27 as the expected value. We'll just put this at 30, and then we'll adjust some other things and come back to it. I just wanted to have that one at least in the right ballpark, so that we're looking at a number that is at least roughly in the right range. What is the current invested capital expectation up to? Okay, so we'll come down to the debt to equity ratio. We have a 25% debt to equity ratio, cost of equity around 10.66 after levering up their beta, weighted average cost of capital of 8.37%, because they do have a relatively low debt to equity ratio. What is their, oh yeah, we do have to adjust their cost of debt, because the listed cost of debt in their income statements doesn't actually show the true cost of all of their debt. So we'll just use the listed interest rate, which is going to shift their weighted average cost of capital a little bit, but didn't really shift it too much. Let me take a look at the tax rate they're currently set to. They're set to 15%. Now they're probably likely to have a little bit of a larger tax rate than that in real terms, but what that tax rate in this particular box is actually set for is not for adjusting their margins, but instead for just adjusting their cost of equity. So I'm going to actually leave the lower tax rate in, because it technically putting a higher tax rate in is actually just going to give them a boost because of the tax advantage effects that it has on the cost of capital. So we're going to leave the 15% tax rate in, even though their effective tax rate might come in around 20% or something. But either way, that's, like I said, it's not actually relevant to the net income margin. So by saying that, it's not like we're saying that they're actually going to pay 15%. We're just making sure that we don't give them too much of a boost to their weighted average cost of capital. So the expected value by default is set to around 46% for the debt to equity ratio, with 0 as the best case scenario and 100% as the worst case scenario. If they currently have around 20%, then they're probably not going to reach 100%. Their current market cap being around 200 billion, you could easily see them dropping 25% or 30% to 150 billion, or even lower than that. With around $40 billion in debt, I could easily see them growing that by 50%. So then that could easily become 60 billion relative to 150 billion, which let's see, what does that come to? That comes to like 40%, or something, maybe even a little bit less than that, but we can assume that the numbers push worse than that. So 40 or 50% is maybe like a worst case scenario for them as far as debt to equity ratio. That puts our expected value at 25% with 0 as the effective level. They have had basically 0 debt before, so for a lot of companies I don't really like to leave 0 as a true best case scenario for them, but I can actually see that as a viable option for them. With the analyst number, we can maybe put it at roughly around where it is right now, about 20. That leaves the expected value at 24%, which is a little bit higher than the current level, and we can maybe adjust these things a little bit further after we play with the probabilities. So going into the sales to capital ratio, their sales to capital ratio, like I said, is relatively low, around 0.5, so we definitely can't have this expectation of around 1. That's definitely pushing things way too high for them. Let's use maybe 50% of what it's currently at, and 50% higher as maybe our guidelines for worst and best case scenario, which gets us a midpoint of 0.5, and 0.5 for the analyst. That'll give us an expected value of 0.5 before adjusting for probabilities. We can probably just really leave it about there. Maybe I'll tilt it a little bit more towards the pessimistic end of things because of the kind of downward trend that this has had. We probably will tilt probabilities more towards the optimistic end of things, as we typically tend to do. So we can adjust this for that in mind. Maybe 0.7 being the best case scenario, so that when it tilts a little bit further towards it, it tilts back up a little bit closer to 0.5. Let's see. We'll go up to returns on invested capital. Seeing the further, like I said, the 3-year period has been 14% or so. Our current expected value with all the assumptions we have in implies in year 5 a return on invested capital of 14.13. So we're roughly in line with where we currently are. So it means the assumptions we have are not unreasonable. They're basically just in line with the present in a large way. We still have to adjust revenues. Now, the default revenue setup that I kind of always have in here is -5% for the worst case scenario, 10% for the best case scenario, 5% analyst number, which gets us an expected value of 2.88 after adjusting for the default probabilities. That's not too far off, honestly, from where I would leave things for Intel. I could maybe say, I don't know, I'd maybe be willing to narrow the line a little bit and say that maybe -2% to like 8%. Like 4% is the analyst number. That leaves 3.15, so that brought it up a little bit. And then, like I said, we might adjust it for the probabilities a little bit. So I mean, I feel pretty willing to narrow my expectations of revenues for Intel. Having been invested for them for a little bit, I feel like I can predict their growth a little bit better than some other companies. I'm willing to narrow that line a little bit. Let's see. So let's take a look at the probabilities and what we want to do with it. I do want to tilt a little bit more into the middle, as I very often do. Then we'll adjust our kind of assumptions for all of that. That brings the revenue expected value to 3.4. I'm still pretty okay with that. Yeah, I'm pretty okay with that. That brings the expected net margin to 28.5. That's where I would want to maybe bring this expectation down a bit, maybe bring the worst case down to 10. Which brings the expected net margin down to 26.5, so that's actually maybe a little bit worse than I was hoping to bring it to. Maybe it's not that bad, I don't know. Yeah, let's just leave it there. That's not that bad. Okay, now let's see how the probability adjustment affected the sales capital ratio. That brings it to 0.49. I feel pretty okay about that. That's about where we wanted it to be. And then that leaves the debt to equity ratio around 23%. It was like 25% only a year ago. It's now about 20%. you know, it feels pretty easy. See, so I mean, a lot of the inputs and assumptions for Intel are honestly pretty easy. It's like even just kind of assuming some pretty straightforward set of assumptions based off of what it's consistently done for a long period of time. It's not that difficult to kind of feel comfortable with these assumptions. But that pushes the return on invested capital implied in year 5 to 13.57 against the last 3 years of 14.18. So I think that's pretty reasonable. That all fits. The only thing left to do then at this point is to adjust for probabilities of defaults. Let's see, pull up in the rating sheet. Let's take a look at their debt projections and total amount of assets that we think they might have. Let's say in the best case scenario, they'll pay it off. Yeah, pretty low chance of default. Doesn't really get much lower than that. Okay. All right. Let's see. Scraping working? No, it should be working. All right, so that'll do it for Intel. Ticker INTC. The U.S. Treasury is selling for 1.778%. The mature market equity risk premium that I currently have is 4.8%, and I come to a discount rate for Intel after adjusting for company specific and industry idiosyncratic risk of 10.33%. The dividend that they currently have is 3.06%. 5 years ago, they had sales of $59.3 billion against sales in the most recent year of $79 billion, which gave them sales growth of 5.88% each year for the last 5 years. The sales to capital ratio for the last 3 years on average has been about 0.49 against industrial expectations of 1.44, and return on invested capital they've had for the last 3 years on average of 14.18. The debt to equity ratio I have for them is currently about 20%, and against that, their default risk in the most recent year was 0.69%, pretty much negligible, about as close to zero as it can get. The profit margins over the last 3 years, adjusted for R&D capitalization, has been about 28.5%, and they have had sales in the most recent year of $21.7 billion. They're currently selling for $47.73, which is extraordinarily cheap. I'm going to say anyway. The probability distribution that we have for them is relatively close to our default model, that we tilted a lot of the negative expectation from the second model into the more neutral middle model. That gets us revenues expectations of anywhere from $71.4 billion to $116.1 billion in the 5-year forward period, with an expected value of $93.7 billion. That gets us revenue growth expectations of anywhere from -2% to +8% per year for the next 5 years, with an expected value of 3.4%. Our sales to capital ratio expected value is 0.49, with a return on invested capital implied value of 13.57%. We're distributing an expected debt to equity ratio for them of about 23%, and against that, they have default risk of 0.69% per year for the next 5 years. Pretty negligible chance of default. The profit margins that we're projecting for them, adjusted for R&D capitalization, is 26.5% on expected value, but it's really a widened range of 10% to 40% or so, with the various probabilities applied in between. And that gets us profit distributions of anywhere from $7.1 billion to $46.4 billion, with an expected value of around $25.4 billion in the 5-year forward period. We have a present value expected price of $55.38 after using the discount rate that we have come up with them, which is 16% higher than the current selling price. The 5-year forward value targets that we have for the company, unadjusted for the dividends that they'll pay out during the period, is a worst case scenario of $22.31 and a best case scenario of $193.48. On an expected basis, we assume $90.55, again, unadjusted for the dividends that they pay out during the period. And that against the current selling price of $47.73 gets an implied return of 13.66% per year, each year for the next 5 years on a compounded average. The value score that we have for them, which is an in-house calculation that we have using absolute returns, relative returns, expected returns, and various other qualitative factors, including sales to capital ratios and profit margins. We come up with a score for them of 0.98. Generally speaking, we consider anything above 1 to be relatively high. In the S&P 500 as an aggregated index generally computes, I think, around 0.65 or so. So they come out pretty good, but nothing super exciting is essentially what that tells me relative to all the other companies that we've valued and have the opportunity to purchase between. The short-term pricing metrics based off of current multiples and a regression output of market multiples and analyst expectations gets us a suggested price for the company of $140, which is pretty ridiculous, but that does have to do partially with how extraordinarily cheap they trade as a multiple, especially relative to the market fundamentals that they have, because other companies with similar fundamentals typically do trade with much higher multiples than that. So that's icing on the cake, is that according to multiples, this company is extraordinarily cheap and should skyrocket in price. But we don't really make our investments based off of this. It's just, like I said, something that we like to think of as like icing on the cake if it matches with the other findings we find, which, like I said, we find that it's worth about 13 to 14% per year for the next 5 years, which is already pretty significant and pretty good. So that's gonna do it for the valuation today. If you're watching and you enjoy in-depth evaluation content like this, please like the video, subscribe to the channel, all that jazz. We stream 2 times a week, Mondays and Fridays, usually around the time that the market closes, as well as for this next earnings season. While the 10Ks are mostly being released, I may or may not be doing a few extra streams on Saturdays in order to fill in a few extra of the companies that I want to value, like, for example, the ones on the list that we had talked at the start of the stream, that I will be doing as quickly as I can whenever they come out. But again, with the caveat that there may be 1 or 2 in place in between, because these dates don't line up perfectly and I have to have something to stream on. So I'm not entirely sure what we're going to be streaming on Monday yet. I don't think any of these next few companies will actually be available at that point. But either way, I will take a look at what few 10Ks have come out and which company looks most appealing at that point. But if you would like to catch us on Monday or any other time we stream, like I said, please subscribe to the channel, and I will catch you all next time.